Good afternoon and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Today's webinar is sponsored by AIADA's longest-term affinity partner, 25 years plus, CNA National. This relationship has benefited AIADA members by offering them F&I solutions specifically designed to increase dealers' profitability and exceed buyers' expectations. Now, before I introduce our presenter, a few quick reminders as always. Everyone that is registered for today's program will receive a copy by the end of next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today we welcome Robert Burghardt, Senior Vice President of Investments at Raymond James & Associates. Robert, I know you have a lot to get to today. Thank you for joining us, and I'll let you get right into it.
Thanks, Rachel. Can you hear me okay?
You're good.
All right, thank you. Well, first off, thank you to CNA National and AIADA for providing me the opportunity to share some thoughts with you all today. For the last 20 years or so, our practice has been focused on helping auto dealers, agents, and service contract administrators in structuring their investment guidelines and strategies for reinsurance companies. We see our team as investment managers, but also a team there to help gather information and provide information to dealers to make informed decisions around the goals of their reinsurance companies. So partner with fellow experts here at my firm at Raymond James, we've got a great foundation to gather and provide information and advice to your clients. In today's call, I wanted to provide some comments that will help you all understand the current state of the market, what trends and opportunities we are seeing, as well as various investment types that may fit your reinsurance portfolios. Additionally, you'll spend a little time talking about current legislation, potential tax impacts, and how they may impact the structure of your long-term planning. Lastly, I wanted to share some timely themes that may be of interest to some investors. There's a lot to cover, so I'm going to go ahead and jump right in. So starting with the current market trends and our outlooks. When looking at the global economy, COVID continues to take center stage. Global COVID-19 cases have risen back to the summer peaks as the Omicron variant causes cases to spike. While cases have surpassed 100,000 per day in the US, we anticipate this surge may be seasonal as people are gathering for the holidays, and we expect economic impact will be more limited as tools to deal with the variant are better known. Turning our attention, looking closer over at the Federal Reserve, Federal Chairman Powell's testimony last week showed greater concern about inflation, stating, quote, factors pushing inflation upward will linger into next year. He also expressed concerns about the Omicron variant and rising COVID cases, noting that virus fears could slow progress in the labor market and intensify some of the supply chain disruptions that we're seeing now. Consumer demand is remaining strong. Retail sales growth rose 1.7% in October, which is well above the pre-pandemic trend, and has been a large contributor to some of these supply chain pressures. Looking forward, global economic growth should remain strong in 2022. Advanced economies where the vaccine rollout has been more successful should see further normalization in activity over the next 12 months. Growth prospects in emerging markets vary, but the reopening of Asian economies is certainly a plus. Domestically, we expect to see US GDP growth around 3.5% in 2022, which is going to be fueled by the consumer, strong job growth, rising wages, and elevated savings balances. The U.S. equity markets fell almost 1% in November and about 3% from their intraday highs as concerns grow around both the impact of the COVID variants and also the Federal Reserve potentially tightening monetary policy faster than previously expected. We continue to favor U.S. equities as we believe the U.S. is better equipped to deal with COVID waves, and our 2022 earnings estimates for the S&P 500 could see some upside movement from what appears to be a watered-down version of potential tax changes from what was originally proposed. While the end of the year is typically the strongest part of the year, the so-called Santa Claus rally, we would not be surprised to see continued volatility as we approach year-end. We continue to favor consumer discretionary, financials, communication services, industrials, and energy sectors, the so-called cyclicals, as the best sectors to benefit from the strong economic recovery and pent-up demand from consumers. Despite some of the headwinds from China, some of it was, as you may know, we had some recent announcements today on Evergrande defaulting. We still remain constructive on emerging market equities over the medium and long term. Valuations in emerging markets remain attractive on a relative basis, but it's very important to be selective. Turning our attention to fixed income, which is probably for most of our reinsurance companies, one of the most important parts of the investment allocation. The Fed has announced it's going to begin reducing its bond purchases, starting to taper at a pace of $15 billion per month, and is discussing now whether to accelerate that pace. The 10-year yield has been driven by counterbalancing forces such as the economic momentum, elevated levels of inflation, and a now hawkish Fed. That's balanced by COVID concerns and elevated forward demand. With that said, we're forecasting the 10-year Treasury to rise to 1.75% over the next 12 months. The longer-term trends such as aging demographics, foreign demand for U.S. bonds, and globalization will likely keep the lid on how high rates can go. Strong credit fundamentals and low default rates remain supportive for corporate credits. As credit spreads widen from multi-year lows, the risk-reward profile for corporates is starting to look more and more attractive. I've added in some slides here just to kind of show you pictures of what's actually happening in the markets. So as we can see here, the U.S. yield curve trend is moving down. So this is from 2019 through 2021. And this is the 10-2 curve. Here we see investment grade and high yield spreads are widening. So as I mentioned earlier in my comments. And then finally, I wanted to just do a quick summary of key outlooks for different areas of the economy that we mentioned earlier. So we do, as I said, we expect another year of strong growth in 2022, supported by consumer spending, rebuilding inventories, and strong business investment. We expect growth to remain above trend at around 3.5% growth in US GDP. In bonds, we expect upward pressure on interest rates over the next 12 months and have a target of about 175 on the 10-year Treasury. We recommend looking at bonds as a portfolio diversifier and a stable income stream, but not as a growth sector for investing. Above trend earnings growth, rising dividends, and low interest rates are supportive of our 49.50 price target for 2022 on the S&P 500. At this point, we're recommending using the volatility we're seeing in the market as pullbacks as buying opportunities within our favored sectors. Overall, from unpredictable events in 2020, such as COVID, the election, to very stable market returns thus far in 2021, we would anticipate volatility to pick up in 2022. Some drivers of volatility will certainly include uncertainty in Washington, the 2022 midterm elections, central banks rolling back monetary policies, COVID variants continuing, and some of the slowing growth issues that we're seeing in China. I wanted to take a moment now to shift over to what we're seeing in the legislative landscape. There's been a large amount of discussion happening in Washington, D.C., specifically lately around infrastructure spending and taxes. Lawmakers have reached a temporary deal to extend government funding through February 18th, and work continues on several other goals, including the reconciliation bill Build Back Better plan. Congressional leaders are pushing toward an end of December deadline to finalize the Build Back Better plan, but it's likely that this may get pushed into January as there's a lot to cover between now and the end of the year. Mixed headlines have emerged from DC this week in terms of Congress's ability to finalize the bill, with several pieces of legislation being passed recently, along with senators spending more time in session working on confirmations of Powell and Brainerd from the Federal Reserve. There's growing talk amongst lawmakers that the Build Back Better plan may not get done in the time that it was originally proposed. Remaining policy issues around Build Back Better are actually the most contentious, including the SALT taxes, immigration issues, and paid leave, which really make it difficult to resolve in the remaining days of 2021. While we don't have final passage of the bill by Congress, the House did pass the $1.7 trillion Build Back Better plan last month. So I want to take a moment to highlight what we know currently to be in the bill and what is not in the bill. Currently, there are no changes to the corporate capital gains, long-term dividend, estate, or individual tax brackets in the legislation, nor is the proposed change to step-up base and assets transferred at death. Individuals with income above $10 million annually will see new surcharges, and a new corporate minimum tax of 15% will be imposed. SALT taxes, while still being discussed, are proposed to have a new minimum of $80,000. A new maximum of $80,000, which is up from the $10,000 currently. Looking at the framework of the bill, there's several key focus areas, including what I've got here on the slide, but $555 billion for climate change provisions, $400 billion for childhood education and childcare, $150 billion for home and community health care, and $150 billion for housing incentives. The goal as being discussed is to offset the cost of the bill with increased investments in IRS enforcement, corporate international tax reform, the 15% corporate minimum tax that's being discussed for large corporations, a stock buyback tax, as well as some other key areas along with closing some of the loopholes on wealthy taxpayers. While the bill is being discussed in the Senate, we remain confident the final version of the bill will be significantly scaled down from the original $3.5 trillion proposals. Other items taking focus in Washington include the increase in COVID cases and the rising concerns about Omicron growth, Powell's more hawkish tone in his testimony to the Congress, the Supreme Court hearings that are being focused right now on a variety of healthcare cases, the nominations and confirmations for the Federal Reserve, as well as the CFPB has been signaling some increased enforcement action, right now focused on overdraft fees and scrutiny of large banks. Turning the page now to getting more focused on reinsurance strategies. Investing for funds for reinsurance companies requires a review of several competing goals. Understand the regulatory and company-specific guidelines and management of entities' assets that may or may not operate in perpetuity. As a result, it's important to have a clearly defined process when putting together the investment strategy, which is what I wanted to walk you through here. My recommendation for insurance company and reinsurance company investments vary based on the specific goals and objectives. At the same time, there's three goals that tend to be very common. And those are capital preservation, generating income, and long-term growth or wealth building. The primary goal of the reserve assets of an insurance company is to have funds available to secure potential claims in the future. With this in mind, our initial recommendation is to create an investment strategy that has limited downside risk. This is why you will commonly see portfolios including fixed income. A common strategy to work with your administrative advisors is to determine what your future liabilities will look like, such as contract terms, loss ratios, cancellation rates, etc., and then match up your anticipated liabilities to fixed income investments. Doing so is a strategy called liability matching. It allows you to target a predicted rate of income and maturities to match your expected claims. Once a reinsurance company has defined its core portfolio, which is usually primarily fixed income, we recommend taking a look at the income you are generating from those conservative investments. Typical conversation we've had with dealers is to target enough income from the core of the portfolio to cover the cost of having the reinsurance company. Things such as annual filings, accounting fees, trustee fees, custodial fees, etc. Doing so allows you to have an expected overall return that is in excess of the cost of the company. The last goal we typically discuss is the long-term growth of the asset. By starting with making sure your liabilities and costs are covered, the owner of the reinsurance company is able to take some risk with the excess assets. This is commonly done in what is referred to as a B account. A B account is simply a second account in the name of the reinsurance company that is not subject to the investment guidelines of a trust or custodial agreement. The B account allows the dealer to maintain some tax efficiency, but allowing for more aggressive investments, thus a higher expected return over time. While the aforementioned strategy is not as aggressive of a return of an ROI or return on investment as many will experience in their own dealerships or personal investment accounts, it's a prudent one for an insurance company or reinsurance companies as it's designed to protect against systemic risk. Other areas we recommend dealers discuss with their advisory team include how the reinsurance company ownership is structured. Reinsurance companies can be an effective tool for estate planning, and the ownership structure of the company should be reviewed for not only tax rules, but also long-term planning. We've seen multiple strategies incorporated to transfer wealth using a reinsurance company, including gifting shares, ownerships via trusts, LLCs, or limited partnerships, and multiple classes of stock or share classes of stock. It's important to align the discussions on the investment and ownership of these companies with your tax and legal advisors, but also make sure you're including your estate planning goals in that structure. When we look at other things that are very popular in the markets with the investing of the primary reserves, I've got listed on here premium bond amortization and bond ladders. And what I'm referring to there is the current environment is a market where we would anticipate interest rates to rise over time from the Fed tapering program, as well as the potential for raising rates to combat future inflation. In these types of environments, we prefer to recommend investors look at premium bonds, which are bonds that are traded in the secondary market and trade at a premium to the current par value. The reason this works well in these markets is that you collect your income at a higher rate, because these bonds tend to have a higher interest rate, and then amortize that premium over time. This should allow you to be able to invest the income that you receive at a higher interest rate while rates continue to rise over time. Bond ladders as a secondary strategy work very well in this environment as well. By laddering out bonds with maturities ranging from the short term to a longer term, the bonds will mature at times when interest rates will have different levels, and thus available to be invested at a higher interest rate for a higher expected long-term return. As we've outlined the basics of where we are in the market, economy, and general reinsurance goals, the most common question we receive is, what is new? What are others doing that I should consider? So while everyone's situation is unique, there are some emerging trends and alternative types of investments that we are seeing that some investors may find appealing. One of the biggest trends we're seeing is increased equity allocations within the reserve trust and custodial accounts. While I just articulated the importance of capital preservation, we have very low interest rates and the potential for large levels of inflation going forward. In environments where interest rates increase and inflation grows, equities have shown to fare better than fixed income investments. As a result, many administrators are looking at ways to increase equity exposure within the reserve assets in a way that does not create too much downside risk. This is usually a discussion that includes the maturity of the company, the historical loss ratios, and current status of the business, whether you're continuing to grow your business or you've moved into runoff. We've also seen an increased desire to use structured and alternative investments within the reinsurance company reserve and surplus funds. The majority of the investment firms that serve insurance and reinsurance companies have a myriad of investment option programs and securities offerings. One example is, as I have listed here, use of market-linked notes and CDs. These investments vary, but it's very common to see a note or CD that pays the holder a participation rate in an underlying index, such as the S&P 500, rather than a fixed amount of income, such as a 2% bond. Doing so allows the investor to have an investment that is technically a fixed income note issued by an investment grade issuer, but the returns are linked to an equity index. With reserve assets, this can be a way to provide additional equity exposure while maintaining the required allocation to fixed income. As I mentioned, some offer these as notes, some as CDs, and they do so with the ability to offer principal protection. So if held to maturity, there's no risk of loss. When looking at surplus accounts, the options are really endless. They depend on the investor's objectives, the time horizon, and risk tolerance. Those discussions are usually held one-on-one between the advisor and the owner of the reinsurance company. But you can think of those as a very long-term option, but should be combined with how long you expect the money to stay within your reinsurance company. So we're at about 20 minutes and I've covered a lot of information, and I hope it's helpful to get a perspective on investing in reinsurance companies. While everyone's situation is different, we're certainly happy to walk through any specifics with those of an interest. In the interim, I again want to thank CNA National and AIADA for the opportunity to share our thoughts. I look forward to speaking to you all again in the future. If you have any questions, feel free to put them into the Q&A and we'll try and answer them as we go through. So with that, Rachel, I'm going to turn it back over to you.
Robert, thanks so much for speaking with us today, and thank you to our webinar sponsors, CNA National and AIADA Affinity Partner, for over 25 years. We look forward to continuing this valuable affiliation for many more years to come. Again, you will all be receiving a copy of this webinar by the end of next week. To those on the line, join us back here on Tuesday, December 14th at 2 p.m. Eastern as Aaron Kerrigan of Kerrigan Advisors discusses the 2022 buy-sell market and what we can expect. For more information about AIADA, visit aiada.org. Thanks for joining us and have a great day, everyone.